Good day. Since our last meeting, near-term prospects for the global economy are broadly unchanged. Inflation has eased over the course of the year, but a further slowdown in inflation looks less certain. Growth forecasts remain muted. The longer-term economic outlook is, however, clouded by persistent risks to the inflation trajectory, the negative effects of climate change, and ongoing geopolitical tensions. In the developing world, financing conditions are expected to remain tight and growth modest. While goods price inflation has eased in much of the world, core inflation remains elevated and oil prices have increased significantly, keeping consumer price inflation from falling further. Globally, monetary policy is likely to remain focused on ensuring that inflation continues to retreat. We expect markets in major financial centers to remain volatile. Across major advanced economies, growth remains stronger in the United States than in Europe. Higher for longer policy rates and extended fiscal positions are expected to weigh on growth prospects for some time. China's growth performance is expected to remain modest, with little benefit to commodity prices. Taking these and other factors into account, the SARB's forecast for global growth in 2023 is broadly unchanged at 2.6% and remains at 2.7% in 2024. Despite considerable reprieve in the winter months, South Africa's electricity load shedding has increased and prices for commodity exports continue to weaken. In the near term, stronger El Niño conditions threaten the agricultural outlook, while global climatic events present additional risks. Energy and logistical constraints remain binding on the growth outlook, limiting economic activity and increasing costs. From a demand perspective, spending by firms, households, public corporations, and general government remains positive in real terms on an annual basis. Disposable income of households continues to grow in the forecast, albeit slowly. Debt service costs of households have increased to about 8.4% of disposable income, close to the average for the past decade. Although growth in credit extension to households and corporations has slowed in recent months, it has increased in real terms compared to last year. The forecast for investment for this year is revised up to 7.7%. These supply and demand trends enabled an upward revision to the bank's forecast for GDP growth to 0.7% from the July figure of 0.4%. Our GDP growth forecast for 2024 and 2025 is unchanged from the previous meeting at 1% and 1.1% respectively. While households and firms exhibit some resilience, economic growth has been volatile and highly sensitive to new shocks. An improvement in logistics and a sustained reduction in load shedding or greater energy supply from alternative sources would significantly increase growth. At present, we assess the risks to the medium-term domestic growth outlook to be balanced. Turning to inflation prospects, our current growth forecast leaves the output gap marginally positive, implying little pressure on inflation from GDP growth. Oil prices have increased in recent months and commodity export prices have moderated further. South Africa's external financing needs will increase as the current account deficit expands from a forecasted 2% of GDP this year to 3% of GDP in 2024 and to 3.4% of GDP in 2025. Sharply lower tax revenue, higher employee compensation, and ongoing financing needs of state-owned enterprises are expected to keep the long-term cost of borrowing elevated. Despite the forecasted moderation of inflation, long-term bond yields currently trade around 12.6%. The rand has weakened over the past year, depreciating by about 10% year to date against the US dollar, and is showing high volatility in response to risk-on and risk-off episodes. The implied starting point for the rand forecast is 18 rands 45 to the US dollar, compared with 18 rands 13 at the time of the previous meeting. The trajectory of South Africa's headline inflation rate has been shaped primarily by fuel and food prices. Compared to the previous meeting, fuel price inflation is significantly higher at 0.4% in 2023, rising to 5.8% in 2024. Our food price inflation forecast for 2023 remains high and largely unchanged at 10.4%. The forecast for 2024 remains unchanged at 5.2%. Better monthly outcomes have led to a downward revision in our forecast for core inflation to 4.9% in 2023 and to 4.7% in 2024. The core inflation forecast for 2025 remains at 4.5%. Services inflation is expected to come in at 4.4%, primarily a result of lower public transport inflation outcomes. Core goods inflation remains elevated and is revised slightly up for this year to 6.3%. Growth in average salaries and unit labor costs is lower in 2023 and 2024. In 2025, salaries are slightly higher. With services inflation lower in the near term, headline inflation for 2023 is revised down to 5.9%. The headline inflation forecast for 2023-24 increases slightly to 5.1% before stabilizing at 4.5% in 2025. Risks to the inflation outlook are assessed to the upside. At a global level, headline inflation continues to moderate, but food price inflation remains high. Oil markets have tightened significantly, and core inflation looks sticky. Despite recent easing in some food price components, domestic food price inflation was still elevated at 8% in August, and the risk of drier weather conditions in coming months has increased. We expect food price inflation to moderate further in the near term, but with high risk that it picks up later in 2024. In the absence of sustained increases in energy supply, energy prices continue to present clear inflation risks. Load shedding and logistics constraints may also have broader effects on the cost of doing business and the cost of living. Given uncertain fuel and food price inflation, considerable risk still attaches to the forecast for average salaries. Sticky inflation implies that average interest rates in major economies will remain high. As a result, tighter global financial conditions are likely to persist, raising the risk profile of economies needing foreign capital. Higher inflation has generally resulted in elevated inflation expectations across businesses and households. The Bureau for Economic Research survey released in September shows average inflation expectations lower at 6.1% for 2023. The committee, however, would prefer to see expectations anchored at the midpoint of the target range. Expectations for inflation in 2023, based on market surveys, are currently 5.8%, and near-term break-even rates have increased to around 5.1%. Longer-term market expectations for inflation remain elevated. Headline inflation returned to below the upper end of the inflation target range in June. In coming months, we expect headline inflation to rise somewhat before sustainably reverting to the midpoint of the target range in 2025. Against this backdrop, the MPC decided to keep the repurchase rate at its current level of 8.25% per year. 3 members of the committee preferred to keep rates on hold, and 2 preferred an increase of 25 basis points. At the current repurchase rate level, policy is restrictive, consistent with the inflation outlook and elevated inflation expectations. Serious upside risks to the inflation outlook remain. In light of these risks, the committee remains vigilant and stands ready to act should risks begin to materialize. Decisions will continue to be data dependent and sensitive to the balance of risks to the outlook. The inflation and repo rate projections from the updated QPM remain a broad policy guide, changing from meeting to meeting in response to new data and risks. The policy stance aims to anchor inflation expectations more firmly around the midpoint of the target band and to increase confidence of attaining the inflation target sustainably over time. The MPC will seek to look through temporary price shocks and focus on potential second-round effects and the risks of de-anchoring inflation expectations. Guiding inflation back towards the midpoint of the target band reduces the economic cost of high inflation and will achieve lower interest rates in the future. Since early 2020, the committee has recommended additional means of lowering inflation that are within the reach of the public sector, including achieving a prudent public debt level, increasing the supply of energy, moderating administered price inflation, and keeping real wage growth in line with productivity gains. Such steps would strengthen monetary policy effectiveness and its transmission to the broader economy. That concludes our statement, and we would now turn to questions. And as usual, please identify yourself and the media house that you represent, and the microphone will come to you.
Good afternoon, Governor Kopano Gumbi from Reuters, and good afternoon, Deputy Governors. Are you comfortable with not just the direction of disinflation, but the pace of it? Is it enough to suggest to the committee that rate cuts would be likely in the first quarter of 2024? I know you've touched on your role in fighting down supply-side inflation before, but I wanted to ask if there's a fresh take on how the committee is thinking of tackling it, given the persistent upside risks that are currently presenting themselves. And then lastly, you say there's serious risks to the inflation outlook. Which of those are your biggest concern?
Good day, Governor, and the rest of the committee. My name is Ntando Tukwana from Bloomberg. Governor, would you say that interest rates have peaked, and when do you think South African borrowers can expect lower interest rates? And is the SARB concerned at all by oil prices hitting over $100 and staying there for some time? And how are you factoring that into forecasts?
None. Okay. Thank you very much. Direction and pace of inflation, direction definitely. Pace not. Inflation initially declined at a very pedestrian pace, and over the last two prints prior to the August one, there was a significant move. The move from 5.4 to 4.7 was a significant move, and the move from the 5 point something to 5.4 was also a significant move. What does this tell us? It tells us that the job of tackling inflation is not yet done. You had identified the take of the MPC of the supply shocks to inflation and whether there is fresh thinking. The answer is there isn't fresh thinking. When you have one supply shock, you can just easily just see through it. When it is a multiplicity of shocks, it starts to fit quicker than normal into other prices, and as such, the central bank would have to respond to those. Which ones of the risks to the inflation outlook do we consider the most important? We have not attached any weight to the risks. We've talked about the exchange rate, we have talked about the oil price, we have talked about food prices remaining sticky, and all of those stuff. They are all important, and the problem here is that data moves around quite a bit and makes it very difficult in the assessment of the take on the direction of the risks. And that is why we have highlighted that these risks remain, and that should we see them materialize, we stand ready to act. Ntando, you ask, have the rates peaked and when can borrowers expect relief? Well, should we maybe ask the question, when could savers be rewarded more? Because you see, the problem with your question suggests that only borrowers in this economy matter. What the interest rate does is to equilibrate the supply and demand of savings and borrowing in the economy. Our focus is not on what borrowers want or what savers want, but our focus is attaining price stability. And in attaining price stability, we would ask ourselves the questions and the interactions between those two important actors, and of course the rest of agents which are determining prices in the economy. But you seem to have been answering your next question, which says that how do we take account of, are we concerned about the oil price hitting $100? Well, if that was to happen, it could actually become inflationary, which means that we have got to be able to assess whether this leads to second round effects, and if it does, then we would have to react to the second round effects. But once again, the problem is that you are not having one supply shock. You are having a multiplicity of supply shocks, and you have got to be able to take your decision on what those means for the price formation process. It took a long time for inflation to come down, and when it was coming down, it was moving at 0.1, 0.2. It's only in the reading of July and June where we saw significant moves in inflation downwards. And as I had cautioned before, the arrival of one swallow does not mean that summer is here. You need to see a little bit more swallows in the sky, then you will know the summer is here. And as we had seen, the July reading was 4.7%, and the August reading was 4.8%. And we expect that the September and October readings might be higher, and we have got to take this as it goes. Any further questions?
Governor Alistair Ball from Bloomberg. Thanks very much, and I enjoyed the summer analogy. You held rates and you've raised your growth forecast, but real interest rates have risen significantly, really, over the last sort of 7 or 8 months. Do you think the South African economy can handle this increase in real interest rates, which is tightening, making your policy more restrictive? And given the weakness we saw in the retail sales and the weakness coming through in the consumer part of the economy, by holding rates high and maintaining that restrictive policy, do you risk tipping the South African economy into recession? Thank you.
Is that the last question? Somebody online?
Yes, Governor, we have a question from Hilary Joffe, who's asking, is the Governor still keen to move the inflation target down to 3%?
Is that the only one?
That's the only one, Governor.
Hi, Governor. Stembile Gele from Bloomberg News. Are the fiscal risks rather outlined by Treasury, such as a bigger budget deficit for the current financial year, as well as lower revenues, of concern to the bank, and are they likely to have any implications for monetary policy? Thank you very much.
Zianda?
Governor, I have 2 questions. One is from Tuleto at Business Day. When will we see the total increase of rate hikes in the ecosystem? As we have heard, monetary policy transmission mechanism works with a lag. Is the continuous restrictive monetary policy stance not too dangerous for the economy? When will we see a cut in rates? Then,
can you repeat the first part of that question?
when will we see the total increase of rate hikes in the ecosystem?
Total increase of rate hikes in the ecosystem. Okay. Okay.
And then the second question is from Atwell Dlamini at Alliance News. The MPC notes credit growth to households and corporates, but commercial banks are reporting an increase in non-performing loans due in part to high interest rates. How serious are bad loans? Does the increase on non-performance loans worry you?
Okay. Fundi, you are going to answer the stuff about non-performing loans. That's what you look at closely. Okay. Let's deal with this now. Alistair, real rates that gone up, you said, in the past few months, and to the extent that since the July meeting, since the May meeting to this meeting, that the real rates had gone up, is not because the Reserve Bank did anything. It's because the effect of the policy is starting to be felt and inflation is declining. Combined with the other drivers that we had identified at the time, food prices coming down and all of those things. And that is important. Real rates, where we are now, are just over 3% in real terms. And on a forward-looking basis into next year, they are still just over 3%. Yes, we have taken a view that the monetary policy stance is restrictive, correctly so, because of the inflation outlook that we had seen. Do we risk tipping the South African economy into recession? No. We are forecasting that growth actually will be 1% next year and 1.1% in the other year. So a recession is not in our baseline. You might be aware that the advanced economies at some stage talked about the possibility of a recession, but it didn't seem like it is coming, that recession. But the economic growth across the world is varied. Hillary, you said the governor. I might just happen to be the most visible official of this institution. I do not represent my jacket. The views I articulate are the views of this institution. There is no virtue in high inflation. High inflation begets high interest rates, and the cries of South Africans over the years had been, inflation is eroding our incomes and our incomes are not keeping pace. And the correct stance to take is to bring inflation down. We have seen how it stood for us. When the COVID-19 hit our shores, inflation was at 4.5%, and it gave the Reserve Bank the space to respond to the shock and thus cushion the economy. I think that by now we had learned that creating that policy space through lowering inflation stands us in very good stead to respond to shocks. Fundi, do you want to do the NPLs?
Yes, thank you, Governor. So, on average, we have seen a significant increase in non-performing loans this year. So, as of the end of July, we had seen a 28% increase compared to last year. Now, all of this has to be taken in context. This is a more generalized number, but the growth in non-performing loans will differ from institution to institution. So this is part of the work that we would do as the Prudential Authority, where we would engage with the entities around what is the level of non-performing loans. So for banks that have got mixed lending, where they lend to corporates and households, you might see that the number is lower, closer to, say, 5% in terms of where the NPLs sit. So for banks that do more unsecured lending, you'll see that the number is a lot higher. And this is what we do in terms of the working with the banks. From a financial stability point of view, on a quarterly basis, we track how big is the growth in non-performing loans and whether that has implications for financial stability. But we have seen self-correction on the side of the banks, because this is what they have to do in terms of being risk-based in their lending. Hence, one would have seen a slowdown in credit extension as well, which is generally what happens when there is an increase in non-performing loans. I hope that's sufficient.
Let me respond. Let me respond to the question. Okay. Let me respond to the question on the interest rate ecosystem. So, as you know, just by way of background, one amongst many other terminologies you become very familiar with in monetary policy making is long and variable lags. And I guess the question is, when you ask when will interest rates take the full effect, obviously, we assume, as many central banks do, that when you have to increase interest rates, you can't deal with the problem today. You have long and variable lags. It takes a while to see the effect of an interest rate increase on slowing down the economy and subsequently slowing down inflation. So, going back to the actual question, we started the process of cutting from 2021, and in 2022 we had a lot of tightening. And I think that when we look at monetary policy today, we are taking into consideration the fact that we have tightened a year ago, and that effect will be seen today. That maybe some of the slowing down in household demand is partly the economy slowing down, but partly the impact of interest rate increases, because that's our objective. Our objective is, unfortunately, we have to slow down the economy to bring inflation in check. That allows us later on to stimulate the economy more and do less tightening further on. So it's a moving target. From the time, one can't be fixated with a year, but or to 18 months. But from the time we started, say 18 months ago, tightening, the effect takes place. There'll be a few more tightenings, but when we think about policy today, we incorporate the effect of those tightenings and how we think it's affected the economy today. Thank you.
Thank you, Chair. Let me deal with the fiscal policy question. But before, I just want to support Fundi's remark about, from a financial stability point of view, we do not see any risk that the increased interest rates is having on financial stability. It has increased non-performing loans, as Fundi has outlined, but it also contributed to bank profitability. And when you take those two as a function of the environment, we do not yet see any sign that the higher interest rates are threatening financial stability. South Africa has a well-capitalized banking system, solidly regulated, good liquidity buffers, good capital buffers, and they can manage the cycle. And we expect them to manage the cycle from a monetary policy point of view. Chair, on fiscal policy, so under normal circumstances, in general, looser fiscal often leads to tighter monetary. In general, a looser fiscal stance makes the work of monetary authorities more difficult. There are times when that's not true, right? So, for example, in the height of COVID, you had a significant economic contraction, and both fiscal and monetary policy was expansionary, and that was absolutely necessary to support the economy. There were times like 2006-07 when the economy was overheating, and you had both increases in interest rates and a reduction in the budget deficit required to help to prevent the economy from overheating too much. So there are times when monetary and fiscal policy would lead to, would work in the same direction. But under normal circumstances, in the normal course of events in the business cycle, weaker fiscal does lead to tighter monetary, and the literature on that is quite standard. I don't want to comment on the specifics of fiscal policy at the moment. There's a medium-term budget policy statement later. It would not be fair for the SARB to comment in public on fiscal policy, especially just before a medium-term budget policy statement. Thanks, Chair.
Thank you very much. Just to say that in determining whether the monetary policy stance is restrictive or is accommodative, one of the things we look at is what is the interest rate, policy rate, at which monetary policy is neither stimulatory nor restrictive. We call that the neutral real interest rate. In arriving at the neutral real interest rate, we have got to take account what foreign neutral interest rates are. There are other things that we consider, but since your question was about fiscal risks, there is the issue of the country risk premium that plays into the picture. That country risk premium is very much driven by the fiscal sustainability of the country. So to the extent that there is a fiscal deterioration, that fiscal deterioration fits itself into the country risk premium. So think of the foreign neutral rate as the slice of bread. The foreigners would want to be compensated. They are quite happy to eat the slice of bread from the US as it is. But since we are some small open economy with these fiscal challenges you have mentioned, the investors will demand that there must be some form of incentive why they should eat the South African bread. And they are not going to eat the South African bread unless you put some spread on it. That spread is the country risk premium. And so, depending on your fiscal stance, the investors will either ask that you put more of that spread, whatever spread you decide to put, whether it's butter, jam, or whatever, they would ask that you add more to that. And that would move with the fiscal matrix that you depict as a country. And that raises the neutral real rate, which basically means that we have got to be able to catch up with that. Put simply, a deterioration in the fiscal matrix raises the country risk premium and raises the interest rate level at which we determine whether monetary policy is restrictive or not. In other words, deteriorating fiscal risks lead to higher interest rates. Where do we see that? We tend to see that in the government bond yields. And that is why we were talking about the South African government bond yields remaining elevated and being at around 12%, in spite of inflation declining to 4.8% recently. So if you take inflation uncertainty into account in that 12% government bond yield, what is left is the country risk premium, and it reflects that the foreigners are not prepared to eat the bread on its own. They would want to have the spread added, and that spread better be sufficient for them to buy it. Because asked the question, I mean, you said, in addition to the credit ecosystem, the financial ecosystem, you asked, when can South Africans expect rate cuts? Well, you are talking as if the focus of policy is just to increase or cut interest rates. The focus of policy is to manage inflation. And so if you want to know when interest rates will come down, look at whether inflation declines to target and stays there on a sustainable basis, then you will know that interest rates will come down. Thank you very much. That concludes the business of today. We'll see you in November.